Welcome everybody, this is George Veter from Veter Financial giving you a market update and also just telling you what's going on out there based on my perspective so that we all know what each other is thinking all the time. This is kind of a historic moment in time in that we're solidly into the fourth quarter now, and we had midterm elections that started yesterday. We'll continue on getting the ballot results today and runoffs all the way to the end of the year. But it looks like there is some shift in power, which will create gridlock in Washington, which is what Wall Street prays for. I know it sounds counterintuitive, but Wall Street hates uncertainty. So if there is gridlock in Washington, a divided government, then usually no new legislation gets approved from left field that Wall Street doesn't see coming. They want to know what cards they're dealt. So gridlock in Washington is the answered prayer for Wall Street and the stock market. So that's how come historically midterm elections have been followed by a rally in stocks. As a matter of fact, every midterm election up until now, since 1942 in the midst of World War II, every midterm election has resulted in a higher market in the next 12 months. So that's a really good trend. We don't know what's in front of us, but we do know what's behind us, and that sets patterns that we can use to plan our future, and that pattern is very bullish. Now, I wanted to talk to you also about how our portfolios relate to the Dow Jones, because that's been a constant question that people have been asking me. We hear on the news the Dow quoted, the Dow was up, the Dow is down, the Dow was up so many points or such percentage or down. And a lot of people identify with the Dow because it's probably the most talked about index, which is a general gauge of stock market, in the stock market direction. Now, the Dow Jones Industrial Average, by way of history, started in 1896 by Sam Dow. And it has been a measuring stick for us to kind of see how the economy is doing based on 30 stocks, because the industrial average is only tracking 30 weighted stocks. Now, most of those stocks were originally industrial stocks. That's why it's called the industrial average. Now there are a few big tech names, but only a few big tech names. So it tracks the stock market to some degree, but it's very limited in its scope because it's only 30 stocks and it's focused on industrial names. Now, the Standard & Poor's 500 is 500 stocks, as the name would suggest. And it's been around since pre-depression as well. It has all of the 30 Dow stocks included among the 500 stocks that it tracks for its average. So we feel like if you had to use one or the other, the S&P 500 is probably a better measurement of the overall health of the stock market because it's a much broader stock average. Now there's also the Russell 2000, which is an index for small cap stocks between 300 million and 2 billion. There's a mid cap average, Russell average for mid caps, which tracks stocks between 2 and 10 billion. Over 10 billion in public capitalization makes them a big cap, and they become household names like a Coca-Cola or Exxon or a Google. Okay? So all of those have to be included in a well-diversified portfolio. So it's not just going to look like the Dow 30 stocks. Now we also need to have some exposure outside the United States because we have a world economy now and free market. So there is what we call the EAFE index, which is Europe and Asia, so our traditional trading partners. And that's being tracked as an exchange-traded fund representing those regions. And then we also have emerging market, which is tracked with an exchange-traded fund to track those regions. Emerging markets will be what we call the BRICS, Brazil, Russia, India, China. There are also smaller emerging markets, but those are the big guys. Each one of those indexes has had a different experience in this bear market. The Dow is only down 10%. Because it has a smaller weighting towards technology, which has been punished the most in this market cycle, and a bigger weighting as a percentage of the average in oil. So the Dow has been recipient. It's still down 10% from its high, but that's better than the other market averages have fared year to date in this bear market. The S&P is down 21% as of last night. The Russell 2000 is down 26%. The NASDAQ is down 38%. The EFI index, Europe and Asia, is down 25%, and emerging markets is down 30%. So again, the worst hit would be the NASDAQ, which is an exchange traded average, and it's been around just since the mid 70s. So most of the newer technology developments and companies that went public to innovate with technological advancements, and the great companies we all know of like Google and like Facebook or Meta Platforms and all these great companies with new themes that have changed our lives, most of those names have come and are traded on the NASDAQ. And so as a percentage of that index, which is almost 3,000 stocks, they have a higher weighting towards technology, and that's why they're down 38% and the Dow is only down 10%. But long term, if you look at 10 years, the NASDAQ's done much better. So again, we want you to be represented in all those themes because we never know who's going to do best next year. World events will unravel, the markets will respond. We just want to make sure that we have a representation in the best of breed of all capitalized companies all over the world, right? And we keep fine-tuning our portfolio model to make sure that the risk-reward relationship is appropriate for the model that our clients are going to have based on what their goals are. When you look at an x-ray of one of our typical portfolios, the biggest percentage that you will see as a concentration for one company inside an entire portfolio will be about 1% of the portfolio. Some years we'll do better, some years we'll do worse, but we want to average a smoother road for our clients to get where they want to go. The rest of what's going on as far as news moving the market would have to be interest rate and interest rate risk. When the Fed wants to tamp down inflation, like has been the theme since early this year, he raises interest rates to slow things down so that we can get inflation under control. And because inflation got very hot, the consumer price index over 8% for several reads, the Fed would like that to be around 2%. We had a lot of work to calm inflation down. We can have other discussions about exactly why we had this inflation, but you just know it's there and the Fed's trying to tame it. And he tames it. His most effective tool is by raising rates to slow things down in response to inflation. Now, is the Fed's aggressive action on interest rates working? I think that it is. The front end, which hasn't necessarily got all the way to the back end consumer experience, is changing based on these interest rate hikes. Everything is calming down based on the Fed's tightening and the effect that's having on consumer spending in all areas. Now, the job market's been super tough, and the Fed's drilling down to try to loosen up the job market. The job market's been tight, 3.5% unemployment, which is historically super, super low. And in order for wage inflation to calm down, we need unemployment to grow a little bit. I know that sounds counterintuitive, but we need employers to not be pressed into paying more for each new hire and having to reprice their products, which is inflationary. So the sweet spot for the Fed is to get unemployment to about 5%. Obviously, we don't want huge unemployment, but 5% is more comfortable and creates a slacker job market where we don't have to continually pay more and more for every new hire and price it into our products. Now, is that actually going to happen? It's been slow to change, but we're in the middle of earnings season for the third quarter, and so we've been getting these layoff announcements. The most current one is Meta Platforms, or former Facebook, and they just mentioned that they are going to be laying off about 11,000 employees. That's not a small layoff, right? Intel has said they're going to do a major layoff. Salesforce announced a couple of days ago they have just under 1,000 people they estimate that they will be laying off. And Twitter, of course, with the takeover by Elon Musk, he's going to reduce his workforce by about half to go to profitability, or to seek to go to profitability. So anyway, there's lots of layoffs, especially in technology, which has been the focus of our growing economy for several years. And that is going to trickle down into a better unemployment figure that the Fed needs in order to justify calming down on these interest rate increases. Anyway, we expect another increase in December, a couple more smaller increases in the first quarter based on the Fed's comments up until now. Of course, that can change. and then we'll go to neutral on interest rates, and then the tightening cycle will be paused. And then if the economy needs it, the Fed's next job will be to stimulate the economy. He does that by lowering rates. And that's the pivot that everybody talks about. And I don't know when that's going to come. A lot of people think maybe third quarter next year. I don't know. I just know that every bear market is followed by a bull market. Just like spring always follows winter, just like day always follows night. And we're in a moment that's been tough to live through because it's scary to be in a bear market, but they're necessary to reprice so that we can grow into the next bull market. And I know that that's coming. Again, I'm not telling you that we're already here. I don't know if we're in an expanding market right now. We have to wait to have more time behind us. But I know it's coming if it's not already here, as far as a healing up and repairing and a new bull market. Anyway, I'm grateful for all of your comments and the opportunities I have to do my reviews with you and phone calls and Zoom calls and all the communication. So grateful that I get to represent you in what your goals are financially. Grateful for my team that services you outside of myself. Please know that we're accessible and that we care and we know what's going on and we've got you. And we look forward to our next communication. Thanks.